Well, looking at that kind of 12-month outlook and also kind of thinking about how you're saying it's going to get worse before it gets better still, I think many of our subscribers are probably wondering, how much more can stocks give up? And, so can you walk us through what your thoughts are and the likely outcomes of what the S&P is going to look like in the next 12 months?
Sure. So I think one way to kind of benchmark your expectations of how low can stocks go is to assume a recession is going to happen and then work from there. Okay. So let's assume a recession does materialize in maybe the back half of 2022 into 2023. Most economists are calling for a recession in the first half of 2023 or the second half of 2023. So let's assume some recession materializes over the next 12 to 24 months.
Okay.
What happens to stocks? Okay. So we have precedents for this. There have been 3 major recessions since 1982. Okay. Since 1985, kind of the modern economy. We had 2008. That was a major, deep recession. Corporate earnings, as judged by the S&P 500's earnings per share, dropped about 60% during 2008, 2009. Okay, so a massive wipeout. We had 2000, 2001. That was another recession. During that period, corporate earnings dropped about 30%. Then we had the 1989 to 1991 recession, corporate recession. Corporate earnings there dropped about 25%. So we can see that based on these 3 recessions, there is one, a very deep one, where earnings just got crushed, minus 60%. Then there were 2 kind of shallow recessions, recessions nonetheless, but shallow, run-of-the-mill, regular recessions, if you will. And those cut earnings by 30%, call it. So what we can expect is that if what happens is a deep recession, earnings are going to drop by 60%. If what happens is a shallow recession, earnings are going to drop by 30%. I think it's very unlikely we get a deep recession. The consumer is too strong in terms of household balance sheets. Corporations are too strong in terms of corporate balance sheets. And the labor market is too strong. I know I said the labor market is going to weaken dramatically, but we're at 3.4% unemployment. So even if we weaken substantially to 5%, 6%, we're still not talking 10, 11, 12% unemployment that we saw during 08, 09. So I don't think we get a deep recession. I think that is like a 2%, 3% likelihood. What is a much more likely outcome is a run-of-the-mill, shallow, regular old recession. If that happens, corporate earnings drop by 30% over the next 12 to 24 months. That's what history says. Let's say corporate earnings peak here in the second quarter of 2022. Let's say this is the peak. This is as good as it gets. Earnings per share on a trailing 12-month basis for the S&P 500 are about $216. So we're looking at $216 in EPS. Take 30% off the top. We're looking at $150 in EPS over the next 12 to 24 months if a recession hits. That is a big drop, 30% drop. One might think, okay, if earnings drop 30% to 150, stocks got to drop another 30%, right? Not right. Because what also happens during recessions is that the earnings compression is offset by some multiple expansion. And it's offset by some multiple expansion for 2 reasons. One, during times of economic pain, of recessions, of contraction, Treasury yields, long-term Treasury yields go lower. As long-term Treasury yields go lower, that provides room for equity multiple expansion. Number 2, as earnings go lower, remember, stock markets are discounting mechanisms. They look to the future. They're forward-looking. As earnings go lower, investors start to pay a premium for those earnings on the expectation that they're so low that they're only going to go higher from here. So multiples go higher for that reason as well. So during recessions, we saw it during 89, 90, 91, during 2000, 2001, during 2007, 2008 to 2009, during March 2020, April 2020 as well. During periods like that, the earnings compression is offset by multiple expansion. Equity multiples tend to expand during recessions. To what levels do they expand to? Well, you look at 89, 90, 91, you're looking at something like we went from around an 11 times trailing earnings multiple to about a 22 times trailing earnings multiple. So a pretty big jump. You look at 2000, 2001, we went from about 25 to 30. You look at 2007, 2009, we went from about 16, 17 all the way to about 27. So we always get to this level of like 25, 26, 27, 28, 29, 30 times trailing earnings during recessions. So let's take that 150, that recession outcome EPS that we're talking about, shallow recession outcome. Let's throw a normal recession multiple on it, something like 27.5. Remember I said it's between 25 and 30, so let's take the midpoint. 27.5, boom. And you're looking at a price target for the S&P 500 of over 4,000, something close to 4,200 within the next 12 to 24 months. We're at 3730 as I speak right now. So 3730, 4,200 over the next 12 to 24 months. Yes, you got to discount that back because money has a time value. Discount it back by 10% per year. We're looking at what should be a fundamental fair value bottom or close to one at current levels, depending if this shakes out over the next 12 months or 24 months. Obviously, the more you discount, the more years you have, the lower your net present value goes today. But the fact of the matter is the math here, the simple EPS math based on what EPS does during recessions, what PE multiples do during recessions. If we get a shallow recession, the math strongly supports the thesis that the S&P 500 is fundamentally either fairly valued or undervalued today, meaning it is probably a good time to start dip buying. And if you've already been dip buying, it's a good time to continue dip buying. Stocks, every bear market turns into a bull market. Stocks always rebound. When they're down 20%, it's always a good idea to buy if you have a 5-year plus time horizon. And most investors should. All investors should. So that's I just said a lot of words there. But
I think it's quite impressive that you knew all those numbers off the top of your head. So
that's the math behind the S&P 500 and where it could go over the next 24 months, and why below 3,800 it looks pretty compelling.
And you did all that on a napkin, right?
Yeah, some napkin. Are these considered napkins?
Yeah.
I don't know. The math for that is somewhere down in here. I don't know. I have too many notes, man. You know that. Way too many notes.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description, or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.